Yeah, so far, like I said, half one results are looking good. Based on Stanbic IBTC's constructive outlook for 2012, of course, on the quarterly review you released recently, you said the drivers of 2012 earnings will be access to cheap funding, lower cost of risk as asset quality improves. And I just want to look at some of these things. For example, the lower cost of risk as asset or quality improves. You said you expect it to reduce by an average of 1.9%. But looking at some of the results we've seen released so far, Diamond Bank's cost of risk was at about 4%. Of course, UBA, we saw their non-performing loan provision at 1.9 billion. What are your thoughts on what these two banks released, and of course how it relates to what your expectations were?
I would say the results were quite positive, and I would say broadly ahead of our expectation. And right now, we're not surprised, because I would say the expectation is that as we move towards the audit cycle, the results would moderate closer to our full year expectation. So if you look at the cost of risk, for example, they're still better than our expectations. For Diamond Bank, for example, we have a full year forecast of about 5% cost of risk, and currently stands at about 4.2%. So it's still better than where we expect it to be, and UBA as well is significantly better than our expectations. Cost of risk for UBA is much less than 1%, currently around about 0.3%, and our full year forecast is for 1.5%. So I would say they're doing quite well on the cost of risk side, and also asset quality appears to be improving as well, and that is not surprising given that the balance sheet of the banks have been cleaned up significantly through the sale of bad loans to AMCON in 2011. So the expectation is that 2012 asset quality will be less of an issue, and so far I think we've seen that with the bank. So I would say the results were quite strong, and I would say better than expected.
Now, another area that you said will sort of drive 2012 earnings was access to cheap funding, Muyiwa. And from the report seen so far, how well are they doing in this regard?
Our view, really, writing the report, was that the banks that we expect to perform the best will be banks that have access to cheap funding. And currently, within our coverage names, First Bank appears to top that list. So as at Q1, First Bank's cost of funds was at about 2.2%. And the expectation is that it should end the year at a worst case scenario of about 2.5%. And if we look at the banks that have released so far, so looking at UBA and Diamond Bank's result, for Diamond Bank, cost of funds increased slightly, went up about 10 basis points from 2.7% where it was at the end of Q1 to 2.8%. And also for UBA, there was a 20 basis points increase in cost of funds to 3.4%. And for UBA, our guidance for full year is about 3.5%, while Diamond Bank, we expect it to end the year at 2.8%. And I would say the reason why Diamond Bank is at a unique position in our view is because if you compare it to its peers, its peer cost of average for cost of fund is around 4.2%. So it's really doing quite well, and we expect that to support its earning growth. And as our Q1 net interest margins was about 9.5%, it's still maintaining that level right now. So we'd expect that to support its earnings. UBA as well, in terms of net interest margins, we've seen an improvement up to about 6% from 5.5% in Q1. So it appears to be benefiting more from a repricing on its loan book, and also from the higher yields in the fixed income market. So I think currently the current macro environment appears to be favoring these banks.
Like you just mentioned, UBA's loan growth, and you actually expected loan growth to be softer this year, growing by an average of 14.7%. Now, specifically Diamond Bank, we talked to the CFO this morning. We saw loan growth, 15% quarter-on-quarter growth in loans, and looking at the year to June, it stood at 25%. Are you surprised by this at all?
Not exactly. We did expect Diamond Bank to be an outlier in terms of loan growth. Our full year expectation is for about 29%, and going by where the bank is right now, it appears set to beat our full year estimates. And I think we're not surprised with that, given the low base of the bank's loan book, and also if you consider that the bank's strategy is to move up the credit curve, so it's moving away from the mid-tier segment of the market and moving towards the Tier 1 segment, and we expect, given the higher volumes in that segment, we expect that to boost loan growth. I think the challenge we have with Diamond Bank, or should I say the challenge the bank has at this point in time, is capital adequacy. Currently, its capital adequacy ratio is 12%. And whilst the bank is currently trying to raise capital, its capital raising process is ongoing at the moment, trying to raise about $500 million. Currently I think it's raised already $70 million. And I think depending on how quickly the bank is able to meet its full year goals, that could slow down loan growth, given that at 12% it's currently close to the minimum guidelines of 10%. So I think that's where the challenge is with Diamond Bank, and that's what could really slow loan growth. And for UBA in terms of loan growth is tracking behind our full year estimates. Currently is about 3%, and our full year estimate is for loan growth of 10%. But we think that next 6 months we should be able to ramp up and meet our full year estimates.
Okay. Well, thank you so much, Muyiwa, for giving us a take. Certainly, we'll be watching the banking results coming out during the course of this week and next week. Of course, that was Muyiwa Oni, a banking analyst with Stanbic IBTC, giving us a picture of what's happening with the earnings, 2012 earnings in the banking sector.